Okay, everybody. Alan, yes, you're right. Aussie has fallen very, very sharply. It's definitely been quite a day, especially for those of you who've been in Europe, been in the trading during the Asia session. It feels like it's been fairly quiet since then. But this is what not this, sorry, bear with me one moment. I just need to talk you through my disclaimers really quickly, guys. The information and opinions in this report for general information use only, and they're not intended as an offer or solicitation with respect to the purchase or sale of any currency or CFD contract. All opinions and information contained in this report are subject to change without notice, and the report has been prepared without regard to specific investment objectives, financial situation, and needs of any particular recipient. Foreign exchange and other leverage products involve significant risk of loss, and they're not suitable for all investors. Increasing your leverage increases your risk. Your spot gold or silver contracts are not subject to regulation under the US Commodities Exchange Act, and contracts for differential CFDs are not available for US residents due to regulatory reasons. Okay, guys, let's just get rid of that. Bring up my and on we shall go. Now, it has been a very interesting kind of 12 hours, I should say, really. Much more interesting in the Asia session than it was in Europe or the US yesterday. Obviously, we had some bigger drivers in the Asia session overnight. We had RBA Governor Stevens kind of giving it large about what was going on, or certainly clearly voicing his displeasure about a stronger currency. And it's quite interesting that the market is now so hardwired, really, to what central bankers have to say about currencies, and they're very sensitive to if the RBA say, or even the RBNZ in New Zealand, if they mention that they're displeased about the currency, they do tend to react, and that's because obviously the RBA and the RBNZ, they don't have interest rates at zero. They're not bound by that zero, or they don't have that zero bound. They don't have that zero bound impact on their interest rates. Their interest rates in Australia is 2.5%. So if they want to weigh on the currency, they could cut their interest rates one day by 50, 100, 250 basis points to get back to where the US is, and that can cause carnage. So if anything, it's that interest rate differential which over the past year has actually weighed on the Aussie and not the other way around. Now, it's interesting, Pan, it didn't move when he mentioned it last week. Stevens did, but he probably wasn't as forceful last week. Added to that, we are now only a few days away from the RBA meeting, so it's probably focused minds just a little bit more. But let's take a look, because this is yen, so let's not look at that, because that is telling a very boring story, which I'll talk to you about later. But as you can see here, daily chart, and we are now through the 21-day moving average, and that is significant. So that comes in about 95.20. We're below there. Interesting enough, we are holding quite nicely at 95. Just looks like we're basing just above there, because we were, this is an hourly chart, as you can see, and on the hourly MACD, we were starting to look just a little bit stretched to the downside. So momentum, as markets often do, that overreacted, if you like, to what RBA governor was saying. And actually some market commentators, some investment banks, for instance, I think TD Securities had come out and said that they thought the market had overreacted, because if you look at the speech as a whole, maybe Alan, maybe you noticed this, but actually the speech on a whole wasn't as dovish on the Aussie, and added to that, it doesn't necessarily change things for their meeting next week, when they're likely to stick with a neutral tone rather than a dovish tone. Yes, so not just you weren't just talking about today. Well, I think you mentioned about the Aussie falling. The Aussie obviously fell precipitously today, but there has been profit taking for sure, and there would be, of course. Let's take a look back at the daily chart. Basically, for the last 2 months, we've moved higher. Now, it does look like as we get to this 200-day moving average at 97.50, I'll just show it to you on my Bloomberg chart. It's just sometimes a little bit easier to look, easier on the eye sometimes. I think what's really interesting is that profit taking has been a real thing that's capped Aussie gains, and it's no wonder really it did coincide with this 200-day moving average. So the markets weren't quite willing to push it above that level. Now, obviously, we've also had a real run-up or should I say concerns, some heightened concerns about China, which has coincided with this sell-off as well. I think investors have been kind of, making hay while the sun shines in case something bad happens. Now, what is it bad that could happen that could weigh on the Aussie? Let's go back to kind of April time. This was around the time that the Fed started sounding out that they would do tapering. That was when they really suggested they'd do tapering. That's when they didn't do tapering, and we moved higher. So obviously, kind of, market liquidity. Markets love liquidity. That's a good thing. But what happened here, around here? This happened. Let's bring up my other chart to show you. These are interbank lending rates in China, so overnight lending rates for banks. And as you can see, we saw them spike in June. Let's just move that, see what happened to in June, we've continued our decline. We were already declining in Aussie. But then they actually spiked last week as well at about the same time as that we backed off from that 200-day moving average. So China has some responsibility for it. Now, as you can see today, China did actually put money back into its system. So basically, it's, China has a funny way of working. It kind of is also in perpetual QE, which some people don't really seem to grasp and think that it's just the US on their own. But they're not as, they're not as trigger happy as the Federal Reserve to keep pumping it in. They kind of pump it in, take it out. But sometimes they can be a bit jolty in the way they do that. And that can cause things like big spikes higher in these SHIBOR rates and these interbank lending rates, because they're basically, kind of at the end or the beginning of last week, they decided, no, we're not going to put more money into the system. There's a credit problem. House price growth is too strong. And so that pushed up interbank lending rates, which should then feed through to higher interest rates for people and withdrawing money from the system. But then today, earlier on today, they came back and said, okay, there you go, a little bit. So they're doing it in a more kind of moderate way. So it is... So as you can see, there's a few things going on in the Aussie. Alan, I agree with you, it's partly technical. Pan, I agree with you as well that it's kind of weird that the market reacts to the RBA one week and doesn't. But again, I think it's largely because we are so close to the RBA meeting now. But I also think it has something to do with this here. And if we can continue to see Chinese rates fall, then that could certainly support the Aussie. But one thing that was quite interesting about RBA Governor Stevens' speech earlier on today was that he did mention terms of trade. Now, don't worry if you don't know that term, what that term means. It basically means, it's basically kind of your imports minus your exports minus your imports. And that's been quite positive in Australia for many years because they export more stuff than they import. They had a positive trade surplus, but that has really been narrowed because of this slowdown in China. So China slowing down means that they require less exports from Australia, particularly the minerals, iron ores, those type of things. And that's really weighed on the Aussie because it was considered that, that demand from China was really propping up the Aussie. So hence why we're back here. Also, I just want to show you something here as well. This is a fib level. To go back to your, just to go back to kind of Alan's view as well. This 95.25 level is massive. It's a 30.2, or I guess it's 38. It's the 38.2% retracement on the upside. So usually around that level we can get a little bit sticky. Obviously we have been higher there. We've got to the 50. We just about got to the 50% retracement of that down move from April to August. As you can see here, we faltered at this point, which also coincided with nearly coincided with the 200-day moving average, so a massive level of resistance. And then we'd fall, and then now we've actually got through the 38.2. Now, a lot of people can really look at the 38.2. We fall down here. I mean, does it open the way to the 50-day moving average? We'll have to see. We do watch what's going on with China closely, but also what's been going on with Australia and the RBA next week too. Alan, you established a new position here on Aussie. What's your opinion on Kiwi? I like the Kiwi dollar better. A lot of people like Kiwi actually, and I guess it all depends on the RBA and Z. They meet tonight. So the Kiwi is going to be really one to watch today. As you can see, really sharp move lower, really backed away from those 85.40 highs. Which kind of were the highest level since May from this year. As you can see there, just look at the length of those candles. I mean, there was an awful lot of selling pressure. We do seem to have found a bit of a base around this kind of sideways movement, which we saw from the end of September to the first week of October. As you can see, though, October has been a month of two halves. for the Kiwi dollar. So we firstly marched higher and then we pulled back very, very sharply. Now the RBNZ market doesn't expect anything to happen. They don't expect them to do anything. There is a little bit of a risk that they may hike interest rates. However, they have also implemented some macroprudential measures, which are measures to mortgages, to make mortgages harder to get, which came into play in October. So we think that actually they will mention those and say, no, we want to see how they work. We think they are going to have a lot of, we do want to see, we do expect them to, mention the fact that they're going to be vigilant about house prices, etc. But really, whether or not we see any further, whether or not we can kind of see a reversal based on a hawkish RBNZ, I kind of think that there's a chance that we may not. Now, obviously, Alan, you're right. It's been a very large drop there's been an awfully large drop in the Kiwi over the last few days. You can see it here. As I said, it was fast, it was furious, and it's the buyers have come in wave after wave and pushed this lower. As you can see, certainly on the downside, we are approaching, we're getting below that 83 levels, quite negative. This kind of 82.30 level, 35 level, say, about 35 pips from where we are now, about 30 pips from where we are now. There is a good support level. Added to that, if we do fall further, this 81.80 level is convergence of the 250 and the 200-day moving average. That could act as good support as well. Let's just put my other chart quickly. This is the daily chart. As you can see, kind of momentum more on the downside. But let's just take a look at the RSI quickly. Just looking at it, whether or not we're kind of oversold here, we do seem to be basing ahead of that 82.50. As you can see here, momentum indicators not really telling us too much, but we are just seeing just a little bit of basing activity going on around 82.50. So kind of just ahead of those lows that I mentioned. These lows from this period here at the end of the end of September, beginning of October. Alexandre, just you, don't you think the appreciation of those is due to the coming crop of wheat that's coming from Australia, it being one of the biggest exporters of wheat in the world and a high Aussie helps the exporters? Well, actually, traditionally a high Aussie doesn't help the exporters because, if they've got a big wheat crop, and they are very big in agriculture, but other countries are also very big in agriculture, like in South America, for example. So if they've got a very strong currency and the South Americans have got a weak currency, then the people that they're going to buy to, or that they're going to be trying to sell to, may go for the cheaper option. So actually, traditionally, a high currency is bad for exporters. So actually, the RBA will be aware of that, and that could be one of the reasons why they were trying to talk down the Aussie. Now, also, I think that, the RBA looks at the economy as a whole. I don't think just one crop would cause the RBA to talk or have a massive impact on the Aussie. Now, of course, what some people may be doing, there could be some hedging going on. Maybe that's what you mean, Alexandre Rescue, in the sense that we could, in the sense that we've got, maybe potentially some farmers or some buyers of the Aussie corn, maybe, hedging their exposure. Maybe they'd bought futures and a better idea, and that happened. But by and large, I don't really think that would have a direct impact on it. Johnny, you want to look at WTI? I'm going to happily look at WTI. I'm going to just start with Brent really quickly though, because Brent got below key level last week, but it's had some interesting price behavior over the last week. Now, you can see yesterday it surged higher. Brent really jumped higher, which is interesting because it kind of defied some fundamentals. Now, it could have been because of fears of a cold winter and things like that, but we had got just back above that 200-day moving average, which is the yellow line here. So we had fallen through that at the end of last week. That came in at 108.40, but we got back above it. So it could have been just a little bit of positioning as well. That 106.80 level, now that was the lowest level really since kind of back into August. So it's no wonder that it attracted a bit of buying interest. And then obviously the high at the moment is this just below 110 level. We backed away from there again today. So we are still looking very vulnerable in Brent. Yes, it was, there was a lot of buying interest there yesterday, as you can see. commodities really did do well, but we're not seeing that follow through today. So we need to see some more follow through. Preferably for the bulls, it would be good to get back above 110, really get back above 170, 110.75, this 50-day moving average, which would then open the way to 112 and potentially even the way back to the kind of 115 level. Now, the trouble with oil at the moment is that we've got an awful lot of capacity. So there's an awful lot of supply of oil, and there's signs that some economies are slowing down or remain a little bit slow. So that's oil's biggest problem. Now let's take a look at WTI. Oh, sorry, wrong one. As you can see here in a minute, we're similar. So we've seen a recovery, but we've stalled just at the 200-day moving average at 98.70. We have stalled there. It is being expected by the market. It may be picked up on some dips, but I'm still a little bit hesitant to really go gung-ho for commodities. The one thing that may boost commodities this week is, of course, the FOMC meeting, and then, of course, the Bank of Japan meeting. If both of them sound very dovish, if both of them, which they are, pretty much expected to, then, the liquidity story could propel oil higher, maybe to that $100 in WTI, 110.75, as I mentioned in Brent. But I still just don't think, I just don't have a good grasp on it at the moment. For me, the biggest story is the, the fundamentals of the oil market itself. And in that perspective, I still see, some weakness there coming through for the oil price, because, we have quite a lot of supply. Let's take a quick look. I just want to show you some, the latest Department of Energy in the US, crude oil inventories. Now, let me just go back to 22nd. Here we go. This is last week with the inventories. Just get the exact one that I need. Crude oil inventories really jumped. Last week we went from 4,000, from this number here to this, to over 5.24 million barrels. We've got, this is Cushing, this is just one area that came in, again, roundabout in line with expectations. Obviously gasoline is lower, but that's largely because of kind of problems in the refinery sector. But I think, in terms of crude oil, there's a lot of it around, there's a lot of it in the US. And that's my biggest concern with crude. I still think that gains will be capped. That's certainly my view. I know other people could say something completely different, but I just think that supply-demand dynamic doesn't really support a stronger oil price. Now, I want to show you, I just want to talk through quickly the euro. My issue, I suppose, with the euro right now is that, the top side is still a bit the weak side. So this is the daily chart. As you can see here, 138. We started at 138 earlier today. I'll go back to the hourly now. Actually, let me just use my Bloomberg. Sorry, just bear with me one moment. So it's just daily action, price action in the euro. As you can see, we started around about just below that 138 level, and then we fell back. So for me, I see kind of, the top side is still just a little bit weak. People are, willing to sell above 138. But I do think that, the market is fading rallies rather than necessarily instituting kind of long-term shorts. One thing that we did note yesterday is that you have a commitment of kind of their flow data, basically. And what they found is that funds are still short euro, even though that is narrowing. So that suggests there could be further room to the upside. So I know some people are really incredulous, or think it's incredulous that the euro is so high, but it does support an argument that we could potentially get even higher, maybe to that 140.11 euro dollar. So Rocco, I would like to know your opportunity when you see Draghi making an appearance. And start talking down your FRAs already publicly displeased. Yeah, France very publicly displeased. I don't know, Rocco, if you follow us on Twitter, but yeah, there's been someone else coming out saying that. France has been very publicly displeased. My argument to that, there was another, I think it was some finance minister or export minister, moaning in France about the strength of the euro, saying it's too strong. I actually tend to think that the ECB in Germany hold a lot more weight in that. So if they do come out and say, so if Germany or the ECB were to come out and say, actually, you know what, we think that the euro is too strong, I think that would hold a lot more weight. I think France by itself, they have a history of trying to talk down the euro. Even President Hollande has come out and done that. And that's not necessarily had an impact. So for me, if anything, I mean, just take a look at this. Since that guy actually mentioned it was about 9:30, we've actually seen the euro push up higher. So, I don't think France is, even though it's important, I think, maybe they have a reputation of moaning about the euro and it does nothing. If the ECB was to talk about something, that would be a different kettle of fish. Now, they meet next Thursday. Remember, we were still fairly strong. Let's just look at a monthly chart here. Just want to show you where we were. So where were we? Beginning of November, around here, around about that 136 level. We've jumped, say, 200 pips since then in a month in euro. So we are noticeably stronger. There were some people worried that the ECB, myself included, I thought the risk was quite high that the ECB would say something and try and talk down the euro. But I think the one thing we've got to point out is that we're in a slightly different environment to where we were back in February when the ECB did talk down the euro from 137.70, fell all the way to 128.80. I mean, Draghi was like a market Svengali pretty much after that, just with his words, no action at all. He was able to talk down the euro. I think we're in a different paradigm now that may make him just a little bit more nervous about doing that. Obviously, the Fed's delayed tapering is not helping the euro's cause because that's weighing on the dollar. But remember, the Eurozone is in a stronger place economically, even though there are still cracks in the Eurozone growth picture. It is in a slightly better place. So, the one thing that I would say is that, maybe he'll be less reticent to talk it down. But if he does talk it down, the market, I believe, will take it quite seriously. Obviously, they have some ammunition. We get unemployment and we get inflation data later this week. And both of them are expected to show, quite a lot of weakness. The unemployment rate, even though it's, going to stay, the inflation rate is expected to remain at 1.1%, so well below the 2% target. So there is a lot of wiggle room for them to do something. So I think if the ECB was to take the plunge, then they may have a problem there. The one thing that they come up against is that actually Germany prefer quite a strong currency because it does. They hate strong inflation. So there's going to be a big balancing out there. And I think, after last time when I guessed incorrectly that I thought he would try and talk down the euro, I think I'm going to be on the sidelines there waiting for him to act. Diz on Eurodollar, how's SSI? Sorry, I don't know if you can just say what SSI means. Maybe I can answer that. But as you can see here, it's pretty clear. We're in consolidation mode. We're not necessarily, I don't see us going anywhere too fast too soon. Speculative sentiment index. Speculative, as I mentioned at the start, actually, there's various ones that you can look at. CFTC, if that's what you're talking about. CFTC readings have actually been delayed because of that government shutdown in the US, so I've not been really looking at those. Instead, what I've been looking at has been UBS flows of funds, and what they've seen is that there's been an increase in longs in Eurodollar. They're still net short, so that can suggest that there could be further upside. What does that mean for a day trader, or what does that mean for the dealing with this particular price movement that we've seen? It could essentially be a bit of a buy on any dips. 137.10. I've heard that there's a rumoured area where there could be some buying interest, and obviously at the moment the top of that range is still that 138.30 level, which is the high from the 25th, so the high from last Friday. Let's just take a quick look here. As you can see, in terms of the daily moving averages, we're well below where we, well below those type of levels. The 21-day comes in at 136.85, so we've got some way on the way down here. Let's take a look at just at euro. This is the 200-hour moving average, which comes in at 137.45. And again, we think that could hold. And then, as I said, that 137.10 level is a rumoured area of buying interest for some big purchases in the market. Pan, you've mentioned about Chancellor Osborne in the UK being very bullish. Doesn't feel like it. I mean, I think it definitely does depend. I think you can certainly say, certainly in London anyway, there are some bullish sentiment indicators that are still pushing the pound. At the moment, the UK data is still coming in better than expected. We had better mortgage approvals, for example. I mean, they jumped to 66.7 thousand. I mean, that's kind of, at least returning to a bit of normality compared to, the fact we've been in the doldrums. There's certainly in the centre of London anyway, seems to be like an awful lot of building activity going on, which is generally a sign of overall strength. And then what was quite interesting about last week's Q3 figures is that we saw the economy expand in all major sectors. So that's kind of good news as well. Growth is a little bit more broad-based. However, it is very much led by services in the UK. So, in terms of what that means for, say, cable traders in the next kind of week, well, firstly, we've got the PMI, the manufacturing PMI on Friday. So that's a big data point. If that misses, the pound has been very sensitive to data surprises on the upside. It's really helped it surge higher, stay comfortably above that 160 level. Good economic data can't keep coming through month after month. It has to end at some point. We've had a good run in the UK. If we start to see economic data pull back just a little bit, maybe miss expectations in the services sector in particular, which is released next week, and that could weigh on the pound. I'll just put the pound up here. But obviously, pound, I do understand what you mean. Like, economic data can move higher, great. But actually for kind of people on the ground and the real economy, if you like, it can sometimes feel like there's been absolutely no difference whatsoever, which can be very, very frustrating when you hear all of this bullish news just because an economic data point has been released. I know, it doesn't necessarily reflect the individual person's reality, unfortunately. But as you can see here with the pound, we've had a bit of a volatile all morning. We shot lower. This comes on the back of kind of pretty much dollar strength. I mean, one of the reasons why the pound has done so well, let's just go quickly back to this daily chart, has been because the dollar's been weak. I mean, you just look at this. This was the end of the government shutdown in the US, pushed the pound higher, back above that 160 level. This is kind of, from, say, September, from that meeting. That was after the Fed didn't taper, pushed higher again, made our way to 163. Now, one thing I would note, just from a purely technical perspective, above 162 towards 162.70, that's a massive level of resistance. That is the top of the market's range, and they seem to be willing to respect it and willing to, take profit at that level. So, that's a short term, certainly anyway, kind of a medium term top in our view. In terms of, the downside, obviously getting below this 160.95, which is the 21-day moving average, is quite bearish. Could get us back down to that 160 level. And I think whether or not we push back to these kind of pre-US shutdown or pre-resolution of US shutdown lows here, which came in around about 159.5, will depend on, potentially the US earlier in the week. So we've got a lot of US economic data, any sign of an upside to data or, potentially less hawkish or less dovish, I should say, than expected statement from the FOMC could also weigh on the pound. Now, the pound is going to be, it potentially could be at risk if we do see kind of a more broader based rally in the dollar. It could be at risk of a real pullback because it's just had such a fantastic run since July. I mean, back then we were sub 150. Now we're sub 160. Now we're above 160. That's quite a significant move. So that no wonder there could be the pound could be vulnerable. Now the other thing I want to show you guys, I know I've taken over my allotment, is gold. Gold has been kind of an interesting one. Gold has come under pressure today. As you can see here, let me just zoom. So we're managing to find a bit of support. This 50-day moving average at 1342. We have heard that this 1325, which coincides with the 100-day moving average, could potentially attract some buying interest. But today, anyway, we think that gold could trade in a fairly subdued manner, fairly tight range, really, because of tightening in China. Tightening in India, not in China. China didn't tighten. Obviously, they have tightened over the last week or so. But it's largely because of, hiking in interest rates. In India, it wasn't expected. The new governor did that because they think they have to shore up the currency. But obviously higher interest rates make consumption lower, likely to be lower. And India is a massive market for for gold, sorry. So, if interest rates in India go up, that can weigh on the gold price. So it has kind of a little bit of an inverse relationship there. And that's what we're seeing. We've seen kind of gains capped very much at 1350 today. But as I said, that 1342 level is imagined to hold the support for now. If it doesn't, then we'd say we could imagine it holding support again at 1324. For gold, I don't have a strong conviction one way or the other. I see, as you can see, kind of range bound. If it can continue to move higher, if there can continue to be fears that, the Fed is going to carry on with its QE eternity, maybe the Bank of Japan sounds very more dovish than expected, then I could see us getting back to 1400, maybe even to 1425, the 200-day moving average, which coincides with the highs from the last week of August. But I just don't see us extending gains upon there, because for me, we're not in an inflationary environment. Inflation has been very weak. And that would be kind of one of the main reasons why. So that's kind of it from me. I know I've overtaken my time. I'm willing to take one more question if someone has one, if I haven't bored you all to tears. Okay, guys, it doesn't look like there's any questions, but please do join me next week for more. It's been great to speak to you as always, and good luck trading this week. Do also remember I'll be speaking at the World Money Show next Friday if you guys are planning on going there. I hope to see you then. Okay, thanks everyone. Bye bye.